This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
In the previous lecture, we looked at simple single product cost volume profit analysis. But as I said at the end, we're now going to make it a little bit more interesting and do the same sort of thing, but when the company's producing several products. They're still going to be interested in things like break even for the same reasons as before. But again, instead of one product, we've got several. And to show you how what you can be asked and how we approach it, look at exercise 6, where it says a company produces and sells 3 products, C, V and P. And there's information there about all 3 of them. If you just run down C with me for the moment, the sales, we're budgeting on selling 4,800 units. The selling price is $5, the variable cost $3.75, and rather kindly, I've worked out the contribution for you. 5, that's $3.75, the contribution is $1.25 a unit. And similarly for V and P, we've got the information. We're making 3 products in the factory, and the total fixed overheads have been budgeted at 8,000. Let's run down it. First of all, A says calculate the CS ratio for each product individually. Well, nothing new there. We did that in the last lecture. But what's it going to be? For product C, contribution is $1.25 per unit on a selling price of 5. So the CS ratio, 1.25 divided by 5, is 0.25 or 25%. For product V, contribution 75 on $6, which is 0.125 or 12.5%, doesn't matter. And finally P, 265 contribution, selling price 7. That's not so nice. 0.379 or 37.9%. So that's straightforward enough. And of course, if there were just one product and I wanted to break even and things, we could do precisely what we did in the last lecture. Here though, because with 3 products, it says calculate the weighted average CS ratio, assuming that the product mix remains unchanged. Now, 2 things I need to explain there. It wants an average CS ratio, so obviously one of my products is 25% and others only 12.5%. Overall, it's going to be somewhere between all of those, if you understand me. But it says assuming budget product mix will remain unchanged. Now the point is here, when we're working out the average CS ratio, we can't simply do an ordinary average and add them up and divide by 3. I mean, I'll tell you why. Just suppose we only had 2 products, C and V. And suppose we were budgeting that, 99% of our sales would be C and 1% of our sales would be V. Well, surely if 99% of our sales were going to be C and only 1% would be V, the overall CS ratio is going to be almost 25%. Whereas on the other hand, if virtually all of our sales were in fact of V and very few of C, the overall CS ratio would be much closer to 12.5%. So it's got to be a weighted average. And there are 2 ways you can get it. One way, I will do it both ways, just then it is clear, but you don't need to do it both ways in the exam. One way would be to take a weighted average, but to weight by the total sales revenue. What I mean is C, V, P, the total sales revenue we're budgeting, C, 4,800 at $5 each is going to be 24,000. And for V, 4,800 at $6 each is total revenue of 28,800. And P, the total 12,000 units at 7 is 84,000. And so in fact, because so many of our sales are budgeted to be P, from what I was saying before, I'll expect the overall CS ratio to be closer to P's than to the other two. But the total sales revenue I'm budgeting on, 24, 28, 800, 84, is 136, 800. The individual CS ratios, 25, 12.5 and 37.9%. And so we take a weighted average. We multiply by the proportion of revenue, so C is 24,000 out of a total of 136,800. In each case, we'll multiply by the proportion and then add up. So V, the revenue is 28,800 over 136,800. And P rather, 84, 136,800. So if you'll bear with me a second while I do the arithmetic, if I multiply by the proportions of revenue and add up, that will give me a weighted average. So for C, 25 times 24,000 over 136,800, I get 4.3860. I'll do it to more decimal places and then round to the end. For V, 12.5 times 28,800 out of 136,800 is 2.6316. And finally P, 37.9 times 84,000 over 136,800 is 23.2719. So the total, the weighted average, 4.3860 plus 2.6316 plus 23.2719. I get 30.2895%. So there's the overall CS ratio, the weighted average. And I'm not surprised that it's as high as it is, because so many of our sales were P, and P did have a high CS ratio. I'll leave it to 4 decimal places, but I'm not really bothered, 30.29 approximately. Well, that's one way you can get it. The alternative, which in some ways I think is slightly faster, is for each of them, CV and P, to again work out the total sales revenue. We've got that 24,000, 28,800, 84,000. So a total of 136,800. And for each of them to work out the total contribution we're budgeting on. So the total contribution we're expecting from C is 4,800 times 1.25, 6,000. From V, 4,800 units at 0.75 is 3,600. And for P, 12,000, 2.65 is 31,800. So we're budgeting on a total contribution of 41,400. And having done that, the overall CS ratio, total contribution 41,400 divided by total revenue gives us, I hope, the same answer. 30.26%. It's slightly different, but I think I've done my arithmetic right. I'm sure you'll accept the difference is just rounding. They weren't nice figures. And don't forget, V and P, P part rather, wasn't precisely 37.9. There was rounding in that. So it doesn't matter. Normally, I find the second way quicker, but either will do. You've probably forgotten, but I did say there were two things I needed to mention. One was that it's not just a straight average. It has to be a weighted average, which I hope I've made clear. The second problem, though, and it relates to what it said calculate the weighted average CS, assuming the budgeted product mix remains unchanged. The point is that on our budgeted figures, there is the CS ratio. Now, fine, we may actually end up selling more, we may end up selling less, but the CS ratio will only remain at 30.26% if we carry on selling in the same proportions. You see, if it turns out that we sell twice as many of each of the products, then okay, the revenue contribution is twice as big, the CS ratio will be exactly the same. And similarly, if we only sold half the budgeted amounts, provided it was half of all of them, the weighting's the same, the CS ratio will be the same. But if we did sell more in total, but it was more C's and fewer P's and more V's or something, if the ratio of the sales changed, the CS ratio will change. So this 30.26%, and that's in fact the one I'll use because it is more precise because that was rounded, but the 30.26% is only going to be valid provided we always sell in the same ratio, 4/8 of C, 4/8 of V and 12,000 of P. But again, it's twice as many, it's half as many of all of them. Having said that, look at C, which now should be very easy. It says calculate the break-even revenue, assuming that the mix remains unchanged. So if the mix remains unchanged, the CS ratio will be unchanged at 30.26% overall. And therefore, to get break-even revenue, we can use the normal rule, which I went through in the previous chapter. To break even, we need total contribution to be equal to fixed overheads. So the fixed overheads here are 8,000. That's the contribution we need. And since the contribution is going to be 30.26% of the revenue, the total revenue we need to achieve to break even is not the nicest figure in the world, but 20, is that what it can't be? 8,000 divided by 30.26%. Yeah, 26,438. Okay, so there's our break-even revenue. Remember, we budgeted our revenue of 136,800, so we can afford it to drop quite a lot. But provided our revenue is more than 26,438, we will be profitable. But yet again, that is assuming that if we do sell less, we still sell them in the same proportions as the budget proportions. Let's go on to part D. Part D asks us for a profit volume chart. Now, I'm dreading this because using the ruler on this computer always causes me problems. But anyway, we've already been through what the profit volume chart is, what it looks like. And again, I'm not going to attempt to be precise, but try and be reasonably accurate. Let me. Not very straight, but still. The profit volume chart, we're simply going to show what the profit is for different levels of production. Although this time, instead of doing it in units, I'll do it as against sales revenue, which in fact tends to be more common. So as the sales revenue is higher, the profit will be higher, and vice versa. Well, of course, if we sell none, sorry, here's profit and here's loss as before. If we sell no units, clearly we've no revenue, we've no contribution, but we've got the fixed costs of 8,000. So a loss of 8,000. On the other hand, well, I may as well use the budget figures I calculated a minute ago. On full budget, if the revenue's 136,800, so, oh well, I'll say there's 100. So 136,800 is perhaps around there. How much will the profit be? Well, the contribution, remember, was 41,400. So given there are fixed costs of 8,000, the profit for that revenue would be 33,400. So if the revenue is 136,800, the profit 33,400. So that's going to be 10, 20, 30, perhaps somewhere up here. What was it, 33,400? So I say I'm not being precise, obviously, but I hope it's clear what I'm doing. But it's going to be linear as always. And so there would be our profit line. As we get more revenue, we get more profit, and of course there would be break even, this time break even revenue. What was break even revenue out of interest? 26,438? It's reasonable, clearly. As I keep saying, it's not precise. So far, I don't think too bad. The only real extra bit from what we had in the previous lecture is understanding how I've calculated the average CS ratio, whichever way you choose to do it, and the fact that that graph I've drawn, that chart, is only valid, we're assuming that however many we end up selling, that it's always in the same ratio, CVP, as the original budget. However, there is one more bit. This time, assume that products are sold in the order of the CS ratios. Construct a table showing the cumulative revenue and cumulative profits associated with this selling order. Ugh. Here, we accept the fact we may sell less than budget, but we assume even if we do sell less, we'll still sell CVP in those ratios. It's now saying that, oh, if we do sell less than we budget on selling, let's sell the best one first, the one with the highest CS ratio, and then the next best, second, and so on. So earlier we worked out the individual CS ratios, and individually P was by far the best one. It's giving 38% of revenue. C was the second best, and V was the third best. And so we're saying this time, if we do sell fewer units, we were budgeting on selling 21,600 units or something. If we did only manage to sell 5,000 units or something, well, make sure we sell the best one first. And only when we sold as many as we can of them, sell the next one, and so on. And so the order of CS ratios, it would be P first, P, then C, then V. Oh, let me write that down, then I don't forget. P, then C, then V. And so which part? Part E, asks us to show a table, or to prepare a table rather, showing as we went through them, P first and so on, what would be our total revenue and total profits. So let's do it. Let me show you what I mean. We're going to sell P first. And so, if all we sold was P, and we sold it in full, how much revenue would we generate? P is 12,000 units. Actually, start again. Sorry. To make 100% sensible, total revenue, total contribution, or total profit, sorry. Let's start from the very bottom. Suppose we sold nothing. Clearly, if we sold nothing, the total revenue is nothing. And what will the profit be? What we said a minute ago. We still got fixed costs, and so we'd make a loss of 8,000. Anyway, now let's carry on and assume we started selling, but first of all, we sell P because it's the best one. Well, the more P's we sell, obviously, the more revenue and gradually more contributions, so the profit starts to, loss turns into a profit. But in total, by the time we've sold all the P's, well, the revenue, there's 12,000 P's at $7. So 84,000. We've still got the fixed overheads, obviously, but that will earn us contribution of 12,000 times $2.65. So the contribution we earn, 12,000, 265 is 31,800. And so what happens to our profit? We've got 31,800. Fixed overheads are 8,000. So the profit has now gone up to 23,800. And we've now sold all the P's. Well, of course, once we've sold all the P's, we can't sell any more. And so we'll go to the next one, which is V. And how much revenue would V earn us? There's 4,800. The revenue is $6 a unit. So it'll earn us extra revenue of, in fact, I'll put it here. No, I won't. 4,800 times 6. We'll get an extra 28,800. We've already got 84,000 from P. If we now sell as many V's as we can, the revenue will go up to, add on 28,800, the revenue goes up to 112,800. And what happens to the profit? We've already got 23,800 from selling P. That'll go up because of the contribution we get from the V's. And how much will V give us? 4,800, the contribution per unit from V is 75. So it's 3,600, isn't it? And so, again, we got 23,800, add on another 3,600 from V, and it goes up to 27,400. And finally, since we can't sell any more V's, the next one we'd make, would be C. How much extra revenue would C give us? 4,800 units at $5 is an extra 24,000. So the total revenue now will go up to 136,800. And finally, what will happen to the profit? We've already got 27,400, but we get the extra contribution from C. 4,800 at $1.25 is, I think it's 6,000. 6,000. And so that'll put our profits up to 33,400. So about making sense there. By the time we're producing everything, we're back to where we were before. If you remember, I did calculate that if we sell everything, the revenue is 136,800 and the profit was 33,400. And is that what I got? Yes, it is. So this is when we're selling all of them in full. But we're showing how it builds up. First of all we were doing was selling P, and once we've made P, then all we do, we then sell these as next best and then C's. Fine. Part F, oh dear, this is going to be fun for me. Add the information that we just got to the PV chart already produced. We've done a few minutes ago, part D, we did this profit volume, but as I kept on saying, that's how the profit would move with the revenue, provided we always sold in the same ratio. Now we're going to assume that we sell P first of all. And what's going to happen? Obviously, if we sell nothing, no revenue, we make a loss of 8,000. If we then started selling P's, then of course we start earning $7 a unit contribution, $2.65 contribution. And as the revenue increases from P, so too will the profit, to a maximum of, once we get to 84,000 revenue, the profit will come to 23,800. Well, 84,000 is going to be, where's it going to be? Somewhere around there, let's say. And 23,800 is going to be, that was 30, somewhere around there. So it's going to be something like that. I can't possibly draw a perfect one, but I hope you're clear. That would be how much in total revenue profit we make if we sold P in full. And as we're selling P, that's how it would go. All right, well, that's the maximum we'd make from selling P. And if we were selling that many P's, then we'd have to carry on and sell the next best, which was V. And V, we'd be starting making that much profit, but by the time we'd sold all the V's, profit would have gone up to 27,400 and revenue to 112,800. So 112,800 is perhaps about there. 27,400 is perhaps about there. So I'll do this one freehand. So you see, that was when we'd sold all the P's. We're now selling these. More revenue, more profit. And we get to that stage. Once we've sold as many V's as we can, then of course we go to the next best, which was C. And the revenue goes up from that much to that much. The profit goes up from that much to that much until we're selling all. And so the final bit goes like this. That's C. And so by the time we're selling all of them, of course, we come to the same place as before. But if sales are less than we're budgeting, then rather than sell them always in the same ratio, we can break even faster if we sell the one with the high CS ratio first, because break even, of course, would be there. By selling P first, we can start to make a profit sooner. And it does, the very last bit does say, add the information for BV chart already produced and calculate the break-even sales revenue on that basis. Well, think about it. To break even, as always, the contribution needs to equal the fixed overhead, so we need a contribution of 8,000. But since you can see that at the new break-even, we're only selling P, the revenue from P, and so the new break-even will be the fixed overheads, as always, but divided by P's CS ratio. And I would have to wind all the way back to remind myself what it was. It was 37.9. And so the break-even revenue, there's a bit of rounding, as I mentioned before, but still, it's about 21,108. And does that look reasonable? Our break-even, yes, our break-even, if we sell everything in the same ratio, is 26,348. If we sold P first, then the break-even revenue is lower. We start to break even with revenue of 21,108. So, sorry about the messing around with the graphs, but I explained the problem. There we are. I personally have a few problems with that. Not the doing of it. Don't think that's too bad. The one thing that is a little bit silly, to be perfectly honest, we're budgeting on those original sales. Now, the budget surely is likely to depend on the demand. The reason I've budgeted on 4, 8, 4, 8 and 12 is presuming that's what I think customers are demanding. I may have got it wrong and customers want less. Fine. But if customers buy less, first of all, they won't necessarily buy less, but in the same ratio of each. And so for that first line to be valid, it assumes, if they buy half of C, they also buy half of V and half of P. The other one we looked at, saying, oh, well, if they're buying less, shouldn't we sell P first and V second and C third? Well, yes, we should, because we can't dictate what they buy less of. It's a question mark. Anyway, that's not for us to worry about. The last page, you've got limitations. I think they're all fairly obvious, but just run through them quickly with me. Everything we did, whether it's single product or multi-product, we assume the selling price remains constant at all levels of activity. It was $6 a unit in the first example. It's always $6 a unit. Clearly, that tends to be unrealistic. One of the ways in which you can perhaps sell more is by reducing the price. Anyway, similarly, variable cost per unit remains constant at all levels of activity. That's not necessarily the case. Maybe if you sell more, you need to buy more materials, etc., and you might get discounts. It assumes that the total fixed costs don't change regardless of level of production. Standard assumption, but of course it might produce high volumes. You might need a second factory. The fixed costs go up. It's assumed that production volumes equal sales volumes. We've made no mention of inventories, and I think you'd realise that could mess things up. And specific to multi-product, We need to know the budget product mix proportions in advance. So of course that is part of the budgeting, but more importantly, that the proportions remain unchanged.